For decades, there's been this massive, almost hidden force connecting the entire global economy in ways you might never expect. It's a financial current so powerful it can fuel huge stock market booms and then trigger global crises. So today, we're going to pull back the curtain on this sleeping giant.
Okay, so let's start with a really simple question. How on earth does a quiet policy meeting in Tokyo connect to a sudden, sharp drop in your stock portfolio, whether you're in New York, London, or Mumbai? Well, the answer is one of the biggest and honestly most misunderstood trades in the entire world.
For more than 30 years, some of the biggest players in finance, we're talking huge funds, have been making what seems like a simple bet, but it's absolutely colossal. And they've been using Japan's economy as their silent partner in this whole thing.
So how is this global financial game actually played? What makes it so attractive that for decades people have called it the source of easy money? Let's get into it.
It all boils down to this one core concept, the yen carry trade. At its heart, the idea is incredibly simple. You borrow money where it's cheap, and for a long time that meant Japanese yen, and then you invest it somewhere else where it can earn a much, much higher return.
Let's break that down. Step 1. For years and years, you could borrow yen from Japanese banks at pretty much 0% interest. Practically free money. Step 2. You take that yen, convert it into, say, US dollars, and you buy assets that actually pay you more, like US stocks or bonds. And step 3, you just pocket the difference. That gap is called the carry. It's the sweet spot between what you owe in Japan and what you're earning somewhere else.
But, and this is a huge but, there's a classic Wall Street saying for this trade. It's like picking up nickels in front of a steamroller. You're making these small, steady profits, the nickels, but you're always facing this hidden catastrophic risk that the steamroller, which is the currency market, suddenly turns against you.
So, the really crucial thing to understand is how this simple little trade ballooned into a multi-trillion-dollar behemoth. The secret? It was a powerful feedback loop that basically turned the whole thing into a self-fulfilling prophecy.
The first ingredient was leverage. Look, a 3% difference in interest rates isn't that exciting by itself, but hedge funds don't play small. They use leverage, often 10 to 1 or even way higher. And by doing that, they could amplify that small 3% gap into a massive 30% annual return. Now that gets people's attention.
And this created a really powerful cycle. See, the very act of borrowing yen and then selling it for dollars put constant downward pressure on the yen's value. A weaker yen made the trade even more profitable because your loan became cheaper to pay back. This, of course, attracted more traders, who then sold more yen, making it even weaker. It was this perfect, profitable loop that just kept feeding itself.
But what happens when that loop breaks? What happens when the steamroller finally starts to move? Well, that's when we see something called the Great Unwind. And it's not pretty. The unwind happens fast. It's a chaotic chain reaction. It starts with a trigger. Maybe the Bank of Japan hikes interest rates. All of a sudden, the profit shrinks. Traders scramble to get out, which means they have to buy back all the yen they borrowed. This sudden rush of buying causes the yen to spike in value. And as the yen gets stronger, brokers start making margin calls, demanding more cash. To get that cash, traders have to sell whatever they can as fast as they can. Their US stocks, their bonds, anything.
And that right there, that's the direct connection we talked about at the very beginning. A simple policy change in Tokyo can trigger panic selling of assets all over the world, which is how you can see a market like the Nasdaq drop a huge amount in a single day. It has nothing to do with the stocks themselves. It's all about the debt that was used to buy them.
And look, this isn't some abstract theory. It has happened before, and it has been brutal. During the 1998 Asian financial crisis, a carry trade unwind almost took down major hedge funds. In 2008, it made the global market collapse even worse. And just recently, in August 2024, a surprise move by Japan's central bank caused a flash crash that sent shockwaves through markets everywhere.
So that brings us to today, late 2025, and the fundamental conditions that made this trade a winner for decades, well, they've been completely turned on their head. The whole game is riskier than it has ever been.
This chart really tells the whole story. For more than a decade, Japan's interest rate was basically zero, or even negative. Now we are in late 2025, and it has been hiked to 0.75%. That's the highest it's been since 1995. The era of free money from Japan, it's over.
You can see the shift so clearly when you put the old reality next to the new one. We've gone from a near zero interest rate to one that's actively rising. We've moved from a pretty stable global environment to one with high geopolitical risk. So that idea of easy money, Forget it. The carry trade is now a very high-risk tactical play.
So, why should you care about this even if you're not a currency trader? Well, because an unwind of this massive trade can lead directly to forced selling in the stock market you're invested in. It can cause those sudden flash crashes you hear about on the news. And it can suck capital out of emerging markets like India and Mexico, putting a ton of stress on their currencies and their economies.
What this all means is that this massive, hidden river of cheap cash that flowed out of Japan for 30 years, it's now threatening to reverse course. That sleeping giant of finance we talked about, it is finally waking up.
This is probably the best way to think about it. For years, the carry trade was like a hose, pushing money out into the world. When it unwinds, it acts like a giant vacuum cleaner, sucking all that money, all that liquidity, right back out of global markets to repay lenders in Japan.
And that leaves us with one final and really critical question. The entire global financial system has, in so many ways, been running on the fuel of cheap Japanese money for a whole generation. Now that the rules of the game have changed, what happens to all of us when someone finally pulls the plug?